Hello and welcome. Today, we're going to talk about the risks and challenges of trade finance and how they can help you and your business grow and expand internationally. Risk management is key to growing a successful trade business, both internationally and domestically, and this can be done through the use of specific types and structures of trade finance products. International trade carries substantially greater risks than domestic transactions due to differences in language, culture, politics, legislation, and currency. This article summarizes some of the main types of risk that international trade financiers may face. International trade has unique characteristics that give rise to different types of risks. Trade financiers therefore spend most of their time understanding and mitigating these risks. Product risks. Product-related risks are those that the seller must automatically accept. As part of their commitment, for example, they are usually required to provide specific performance guarantees, agreed maintenance or service obligations. The buyer must consider how external factors, such as negligence during production or extreme weather conditions during transport, may affect their product. These issues may well lead to disputes between the parties, even after the contracts have been signed. It is important for the seller that the contract is drafted correctly so that any changes that may affect the product are covered, with clear outcomes. Manufacturing risks. Manufacturing risks are particularly common for products that are custom-made or have unique specifications. Sellers are often required to cover the costs of any adjustments to the product until the buyer deems it appropriate, because the product cannot be resold to other buyers. These types of risks can be addressed as early as the product planning stage, which often means that the buyer has to assume payment obligations at a much earlier stage of the transaction. To mitigate the risks for both the buyer and the seller, especially for custom-made products, payment terms can be partial payments and separate guarantees throughout the design, production, and delivery of the product. Transport risks. These are the risks associated with the movement of goods from the seller to the buyer. Around 80% of the world's freight transport is by sea, which gives rise to a range of risk factors including storms, collisions, theft, leakage, spoilage, sinking, piracy, fire and robbery. Cargo and transport risks can be reduced by means of cargo insurance, which is usually defined by the standard international policy wording issued by the Institute of London Underwriters or the American Institute of Marine Underwriters. The agreed terms of delivery will usually state who is responsible for taking out the insurance. If the buyer fails to insure the cargo shipment adequately when it is their responsibility, the insurance may be invalidated if, for example, the port or transport route changes and the items arrive damaged. Exchange risks. This is the risk posed by fluctuations in exchange rates that can affect payments and receipts in foreign currency. Unless this risk is hedged, a trader has no control over the impact of exchange rate volatility and, in a worst-case scenario, this volatility can wipe out all the profit and more that would have accrued from the trade. Foreign exchange risk management is often misunderstood or overlooked by businesses. Any business that buys and sells products or services in multiple currencies should consider options to mitigate foreign exchange (FX) volatility. Changes in exchange rates will impact the profit margin on international contracts as well as the value of any assets, liabilities, and cash flows denominated in foreign currencies. There is a range of financial instruments available to manage foreign exchange risk. Given the increasing volatility of the market and the need to operate in multiple currencies, policies need to be flexible and adapted accordingly. Before developing a foreign exchange strategy, a business should consider what proportion of its business is related to imports or exports, the currencies that are being used when payments are made, and which currency is used for supplier payments and invoices. Various strategies are used to manage foreign exchange risk and typically involve the use of spot contracts, options, and forward contracts. Country risk. A set of risks associated with doing business with counterparties based in a foreign country, including foreign exchange risk, political risk, and sovereign risk. Factors to consider when considering country risk include the current political climate in the country, the state of the local economy, the existence of reliable legal structures, and the availability of hard currency liquidity. Corporate risk. These are risks associated with importing or exporting companies and focus primarily on their credit rating and any history of defaults, whether due to non-payment, non-delivery, or defective delivery, e.g. defective or damaged goods. Commercial risk refers to potential losses arising from weaknesses arising from or defects in the underlying trade. These factors may include the quality or suitability of the goods traded or the strength of contracts and pricing terms. Fraud risk. These are risks typically associated with unwittingly engaging with a fraudulent counterparty, receiving forged documents, or falling victim to an insurance scam. Document risk. Documents play a vital role in international trade. Missing or incorrectly prepared documents pose risks to both buyers and sellers, as they can cause delays in shipments and ultimately delays in payments. If you liked our video, please like, comment and share so that this video can reach more people. Thank you for watching and see you next time. And follow us on Instagram at BusinessGreenBR.